Hi, welcome to another edition of Lipper's Fund Flows Insight. My name is Tom Rosine. Thanks for joining me this week. I'm going to be reporting flows for the week ended Wednesday, November 28th, 2012. It really was a tale of two cities as we take a look at the numbers this week. We had about $13.3 billion come into the conventional fund business. That would be without looking at the ETFs. We'll talk a little bit more about that later. But the tale of two cities really came from investor behavior. We actually had fairly good returns for the week, about a 1.14% return for equity funds from Wednesday to Wednesday. But what we saw was people were very concerned about the fiscal cliff and also still hearing about the European debt crisis. None of these have been resolved. Despite hearing some really good news, though, from both Germany's, the IFO number that came out, and also from China with their purchasing managers index coming out good, and even good news on Black Friday and Cyber Monday, investors were really hesitant to put money back to work. And it's one of the things that we're going to be able to take a look at. Really we had very strong returns. One of the best weeks that we've seen from Friday to Friday now. We had a 3.35% since June. So really it was a really strong week, but again we had some mixed feelings, mixed behaviors, and it was really because of the looming fiscal cliff. We need an answer for that. Let's take a look at our macro group to see how flows panned out here. If we take a quick look at it, money market funds had $11.4 billion in outflow or inflows, and that's where most of the money came in. So I said it was $13.3 billion of net new money coming in. It really was in a very conservative asset class. We're going to find later on that this was primarily due to institutional investors, but equity funds saw just a little bit of outflows, a little bit under $300 million. Taxable bond funds saw a small inflow, $1.7 billion. They've been doing 2 to 3 billion a week, so that's a little bit on the low side. And muni bond funds kind of returned back to their norm of having about half a million dollars in net new money come into their coffers as well. And again, one of the reasons that we're going to take a little closer look is we really had a divergence on how money was coming into the market. When we take a look at equity funds as a whole, we saw that we did have a 1.14% return for the week. That was very strong. It's the second week in a row, though, that we've actually seen this type of positive return, but the third consecutive week that we've seen outflows. And again, about $281 million in outflows occurred. Well, here's part of the tale of two cities. Domestic equity funds saw about $770 million go out of their coffers, while the non-domestic equity funds saw about $490. And this is the ninth consecutive week that we've seen inflows into the non-domestic equity funds. And one of the trends that we're seeing is certainly the story about emerging markets. Emerging market funds saw about $272 million in net new money coming into their coffers. And literally, international equity funds was a big draw for all the equities when we're looking at the open-end funds universe. They saw about $532 $1 million come into their coffers as far as net new money goes. And again, the majority, the lion's share, came from emerging market funds. And that's where the story is. Well, here's the real tale of two cities. Equity ETFs actually saw about $7.7 billion in net new money come in. It's the first week in three that they've actually seen money come into their coffers, but the normal funds that we've been seeing and talk about quite often, SPY, the Spider SP 500, saw $3.6 billion net new money. iShares Emerging Market Fund saw about $1.4 billion in net new money, and the iShares Russell 2000 saw about $1 billion in net new money. At the bottom of the list, we saw science and technology, financials, and a healthcare firm actually saw a little bit of outflows, and it's not a big number that we're taking a look at. So one of the things that we've talked about in the past was investors looking for yield. Well, that was not necessarily the case. Again, I think people were a little bit dazed and confused by the inaction, the inability of Congress to actually work together. You have the president promoting one piece, you have the Republicans refusing it, and investors are not feeling too comfortable, but they still were able to put money away in fixed income funds. So let's take a look at the fixed income fund group, and we see that for the fourth consecutive week, we've seen net inflows, $1.7 billion, not again the biggest number that we've seen as of late. We've seen some pretty good flows into that group. It's the second week in a row that we've actually had positive returns, about a 0.41% return, nothing to write home about, but again, a positive. And we saw that corporate investment grade debt funds, a little bit more on the conservative side, was the bigger tractor, $907 million. Now in the past, we've been talking about high yields and some of the high flyers. This time, we're really focusing on conservativeness. People are preparing for the worst from Congress. Our congressional leaders are basically preparing us, and I guess we're preparing ourselves for falling off this proverbial fiscal cliff. And another thing that we saw also, it was for the 24th week, so for the corporate investment grade debt funds, and also for flexible portfolio funds, we saw about $332 million in net new money come into their coffers as well, and it was for the 24th consecutive week that we've seen inflows. So those two groups have actually seen some pretty strong money as far as coming into their coffers. And by the way, that is a yield play because that's going a little bit more on the risk spectrum for most people. Now, if we take a look at the ETF world, we get a little bit of a change because ETFs, first of all, they're not that well known for their fixed income attributes. So we're growing that group now, but we only saw about $68 million of money come into their coffers. So it really was quite a slow week for those folks. And we can see what they did. They actually did put in a little bit of risk. We saw the SPDR, Barclays High Yield Bond Fund, J&K, taking about $160 million. We saw iShares, the JP Morgan US dollar, taking that CMB, taking about $8 million. But at the bottom, we saw treasuries at the bottom. And it really, if you take a look at these numbers, they're almost nothing, next to nothing as far as flows go. So I think people were a little bit concerned, even from institutional investors on the ETF side, that in fact, if we take a look at fixed income securities, maybe there is a little bit of priciness in there already. Well, let's take a move and go to muni bond funds. Muni bond funds for the 7th consecutive week saw positive returns, about 0.34% positive return. This is the 32nd and 33rd week that we've seen inflows, and it was $491 million. Again, not the biggest numbers, but certainly back to that kind of normal of just knocking away a half a billion at a whack, and certainly was a good news for the muni bond fund investors as well. National munis took in about $407 million of that net new money. So it really has been going mainly into nationals and not so much into single states. Well, now we get to the money market funds, and we've been seeing these kind of big moves into money market funds. $11.4 billion was what the net inflows were, and this is the 3rd week in 4 that we've actually seen inflows, and that tells us that there are some investors out there, and you're going to see here in a moment, or I'm going to talk about it in a moment, that it's institutional. People are parking their money and they're really risk averse. So this is kind of that ability for kind of risky assets, kind of saying, listen, we don't care if we earn any interest. We want to park it, we want to hide it, and we want to sit on it until whatever this turmoil is over. And how we got this breakout is we saw for taxable money market funds about $12.3 billion of net new money come in. Of that, 12.5 was by institutional investors. So that means that we saw an outflow of about $0.2 billion from the retail side of the industry. They're just pulling it out of the regular money market funds. And then we take a look at the taxable money market or tax-exempt money market funds, and we saw an outflow of about just a little bit under $1 billion, so about $0.9 million or $1 billion as far as outflows goes, as far as that group goes. So again, what we're taking a look at it, and we really have been scratching our head on why we've been seeing these big flows in and out, and we really are now attributing it to institutional investors parking their money and doing what you would call loss avoidance. They're taking it, putting it on the side, and then when they see an opportunity to put it back to work, they're pulling it back out and they're putting it into another ETF instrument normally and getting those small movements. So they're really playing these moves in the market. Well, we heard some disappointing news this morning about personal consumption. It was down 0.2%. That's a big number, but we can probably attribute that to Sandy. And as we go forward, I think we're going to see revisions up as we take a look at those numbers going forward. And in addition, I think until we hear some good, clear, resounding facts from Congress and the President that we are going to do something about the fiscal cliff, I think that investors, particularly equity investors, are going to be sitting on the sidelines, being very nervous and really picking and choosing when they get back in the market. So we're kind of in that troubled area. If by happen to chance, so we do see the Congress get together, President get together, and actually submit something before Christmas, we could actually see a good Santa Claus rally by the end of the year. Well, join us next week, and we'll be able to show you a little bit more detail. Or if you want to do some more digging on this week's information, you go to lipperusfundflows.com and do a little deeper dive on your own. Well, my name's Tom Rosine, wishing you the best in your wealth planning and creation.